Everything comes down to time horizon. Firstly, don't put too much money in that you can't afford to ride the volatility. I've told everybody this for 2 years now. Expect 50% drawdowns as normal course of business and not calling it a bear market, just calling it a correction. So that's what we need to deal with, and everybody needs to make their own decision. It's also time horizon. If you think it goes up, 20, 30x over the next 5, 6, 10, whatever your number is, well, then a 50% drawdown is just small noise on the chart.
Macro investor Raoul Pal in his latest interview breaks down why he thinks the broader market has it wrong, and we are going to see a rotation back into risk and growth throughout 2022. Due to fears that the Fed is going to rate hike multiple times to curtail out of control inflation, innovation stocks along with crypto has been hammered for the last few months. In this video, Raoul breaks down why historically there has been a 100% hit rate in markets overestimating how much the Fed will raise rates and why this will cause a breakout in the growth and crypto markets. Make sure to stick around to the end of the video where I will cover the latest on-chain Ethereum data to see if it backs up Raoul's thesis. Also, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and can always change your mind.
If you're trading for a 3-month time horizon and it falls 50% on you, well, you've got it dead wrong because your time horizon is different. So I am looking to add more to my positions into this kind of market because I don't think anything's changed. Nothing's changed in the network adoption. Network slowed down a bit for the reasons we talked about before. So over time, we see the institutions coming. I'm talking to them every day. I launched a crypto fund of funds. We've already put the first $100 million to work. That goes straight into the markets via the hedge funds. That ongoing allocation of assets is happening. So it doesn't stop. So it trades sideways for a year. That's great. Tends to mean periods of suppressed volatility lead to hyper volatility. Periods of hyper volatility tend to lead to periods of suppressed volatility. And we've basically had a sideways market where volatility has been falling since May. So that's how I think about it. In terms of the allocation of tokens, the answer is I don't know. Yeah. It's complicated. We had a big move in the layer ones, AVAX, Terra, and Solana. Usually chasing the previous theme is a way to lose money for the reasons you said before, is you're not taking advantage of weakness. What you're trying to do is follow the momentum in a market where people are just rotating. That's usually bad. You can add to momentum trades when the whole market's in momentum, not when it's rotating. So where could the rotation go? That's the question you should be asking. Well, some of these DeFi ones had a big run in 2020, haven't done anything, have fallen 70%. Maybe it's DeFi. Maybe it's the interoperability, the ones that allow you to move things from one chain to another. They haven't really had a big run. Maybe it's those. Metaverse have had a run, NFTs have had a run, Layer 1s have had a run, Ethereum's had a run, Bitcoin's had a run. So you need to be thinking, okay, what hasn't had the run yet? Yeah. And again, I wouldn't try and look for one particular single token because your probability of success, unless you really know it, is super low. Build a basket of stuff, equally weighted, don't take too much risk, wait and see. My view, and it has been all year, and I've been looking at this whole junction all year because I think it's the bigger trade, is I think the Fed are not going to deliver what they say. I looked at every recession going back to 1963, and almost every single time there is a growth scare early on because the economy's not fully stabilized yet. So what happens is stimulus comes out of the economy, fiscal stimulus. The Fed start talking about tightening because inflation's risen, because the year-on-year rate of change and stuff like that. This time we've got supply issues. And then what happens is the Fed think about raising, and before you know it, growth evaporates again. And then the Fed actually end up cutting. So I think we will get a couple of rate rises in, potentially, maybe only one. That's my view.
Why?
Well, because I think by June, I think inflation's back down to 3%, and the ISM is probably closer to 52 than it is to 60. So you don't want to tighten into a falling economy going into an election. I know the narrative now is, well, they need to tighten to look like they're fighting inflation. Best thing to do is talk tough, get a rate hike in, maybe two 25 basis points in, then let the natural kind of ebbing and flowing of the economy work in your favor, you can say, we've beaten inflation, and then you can get a stimulus package through.
Yeah, take a victory lap that we jawboned it before we had to actually do.
And then stimulate ahead of the election. I mean, that would be perfect for them. So if the market is wrong in expecting higher inflation for longer, then growth stocks will explode higher again. Because really, let's face it, we live in an exponential age. Anybody who thinks that tech stocks, high growth, long duration tech stocks that are capturing exponential rise of technology are not going to go up again, that can't happen just because of network effects of what's going on. We're not talking about IBM here or GE stock, or some of these things can trade sideways for decades, but you can't trade sideways for decades when you've got exponential growth going on. It just can't happen. Now, you can have periods of a year, 18 months of sideways down markets, which we've been seeing. But then what happens is they end up looking ludicrously cheap versus what's happening. And the moment the inflation story disappears, then everyone piles into growth again. Crypto is similar to growth. It's driven by its own network models and adoption. There's a bunch of other stuff. But similar to that, I said crypto had been trading sideways because wage growth has not kept up with inflation. So marginal dollars to invest by retail has been reduced. And I think that it gets partly caught up in the growth story, but there's no correlation really between bonds and crypto, the dollar and crypto. They're all passing correlations that come in and out. You know, suddenly the S&P is correlated for a bit and then it's not. So I don't worry about that. I just look at the network effects over time. But if the Fed increase the size of the balance sheet, then it's all correlated because you're lowering the value of the denominator. So that's why when the Fed increase the balance sheet, what you find is that everything goes up. Now, does it happen when the Fed decrease the balance sheet? Are they going to shrink the balance sheet? And does that crash the markets? If they do it, markets will stop going up as much because of the fact that you're increasing the value of the denominator. So it changes that. So yes, we saw it last time around. There was a period of time as the Fed were reducing the size of the balance sheet. No, they kept the balance sheet stable. Stocks were sideways for a while. But then even with a stable balance sheet, stocks took off again because the growth story is still underlying. What the market won't like is raising rates. It took 8 times before the market cracked last time. So it never happens on the first couple of goes. The market has a wobble, but then it shakes it off. So it took 8 times last time, and it took the balance sheet taper. And then the market started rolling over. So we've got inflation. What happens? You raise rates. What happens? Markets eventually slow down. The economy slows down. Eventually the stock market goes down. And eventually the Fed come back in because they can't allow the collateral of the market, the equity market, the bond market, whatever, to fall apart. So then they stimulate again. So I'm like, well, it's kind of a never-ending cycle of even if it comes off, it stimulates. So I'm not worried by it, really, I guess.
So there's Raoul with why he thinks the market has got it wrong, and we won't see as harsh a reaction from the Fed as expected. Now, to cover some of the latest on-chain Ethereum data to see if it backs up Raoul's thesis, but first I'd like to introduce you to Masterworks, the platform that lets you invest in one of the best performing alternative asset classes of all time, contemporary art. The art market is on fire with the total wealth in art estimated to be $1.7 trillion. The Wall Street Journal reported that art is amongst the hottest markets on earth, with Deloitte projecting the space to grow by $900 billion by 2026. And that's probably because contemporary art has outperformed the S&P 500 by nearly 3x since 1995, yielding an annual return of 13.6% over this period. Although past performance doesn't guarantee future results, these figures are impressive to say the least. But not only does it outperform, high-value contemporary art can also protect against inflation due to scarcity. In other words, art can be a great tool to diversify your portfolio. Masterworks.io is a company that gives everyone access to top-tier blue-chip investments, so now you don't need millions to invest in the very same type of paintings as Jeff Bezos and Bill Gates. Masterworks.io lets you invest in works ranging anywhere from $1 million to $30 million without breaking the bank. Setup with Masterworks takes just a few clicks. You visit their website, create an account, browse their artwork, and you can instantly diversify your portfolio with one of the oldest and most stable assets around. If you want to start investing with Masterworks, there's normally a waitlist, but I was able to get you guys a link allowing you to skip that waitlist. So if you want to start investing with Masterworks right away, use the link in the description below. Now, back to the on-chain Ethereum data. Reporting out from the block is that on-chain data is showing that Ethereum addresses with a non-zero balance is just hitting all-time highs. Despite the price action, we are still seeing adoption on the network, and this is incredibly steady. On top of this, the number of transactions on the Ethereum network, although isn't currently at all-time highs, if you zoom out on the chart, the trend becomes very clear. Keep in mind now with EIP 1559, with each Ethereum transaction, a portion of Ethereum is burnt, having a deflationary effect on supply. If this continues into ETH 2.0, where Ethereum will become truly deflationary, the supply crunch can only force price in one direction. Anyway guys, hope you all enjoyed today's video and that provided you with some value. I'll see you all in the next video, and as always, have a great day.